Most DeFi investors are struggling with outdated strategies from 2023, expecting them to work. And the truth is, you can't just open up a liquidity pool, expect to beat divergence loss, or expect to make money anymore. And the reason why is because there is competition these days. While these videos don't get a lot of views because I truthfully don't want these strategies out there, so I don't market them like they should get a lot of views, there is a lot of people watching content like this on YouTube. There's a lot of people trying out these strategies, and there are a lot of people investing into liquidity pools and concentrated liquidity. So today, I'm going to show you the strategy that I'm personally using to compound my wealth quickly in DeFi, and at the same time that other investors are using that have at least $25,000 of capital to consistently generate 50 to 150% APR. I think a lot of people are actually forgetting where we are in the market, and we're getting closer and closer and closer to Bitcoin all-time highs in the end of this bull market as we know it, and getting closer to the start of a bear market. So we need to be preparing, and that's why we like to include market neutral strategies, otherwise known as delta neutral strategies. Those could be stablecoin liquidity pools where we just deploy our capital into those two stablecoins, earn maybe 20% APR or so. Those could be stablecoin lending where we earn maybe 10% or so just by lending out stablecoins or staking them or something along those lines. Or those could be delta hedge liquidity pools where we execute on market exposed liquidity pools but hedge out our market exposure to consistently generate more income. Truth be told, you're probably stuck using single dimensional strategies that worked all the way back over here in 2023, or maybe even in the upbringing in 2024, but now it's 2025. There's a lot more competition, and your strategies haven't evolved at the same pace that the market has. The market is now more sophisticated and requires better strategies, but also more advanced strategies to consistently generate profits. And that's why we use asset accumulation strategies, which focus on acquiring more assets. So that way, whenever the market does start to go back up, whenever Bitcoin goes, up 5-10% in a day, not only are we seeing that 5 to 10% on the initial Bitcoin that we started with, maybe that was 1 BTC, but we are seeing more appreciation because we don't have 1 BTC, we have 1.1 or we have 1.2. We're stacking the amount of BTCs that we have basically by using these strategies. We're not focused on dollars, we're focused on stacking the amount of BTCs that we have so that way we can accumulate more of them. That right there is the goal with asset accumulation strategies. But on top of that, we include what I like to call stability strategies. And those stability strategies do focus on that dollar right there. And what do? They mitigate that downside. So that way you don't have exposure to the downwards market. And they also mitigate that upside, right? So you don't have exposure to the upwards market when Bitcoin is appreciating. But what they do is they consistently produce yield over time and consistently generate dollars. And that right there is our profit. I'm going to be hosting a free Rescue Your DeFi Portfolio workshop where I break down the difference in detail of these asset accumulation versus stability strategies. So that way you can determine, number one, what type of investor you are, but number two, what type of strategies you should be including in your portfolio and how you can go out there and find them. You guys will need to RSVP for that event if you do want to be there, and the link is going to be right below this video. You just simply head to this webpage, hit RSVP now, and you'll be prompted to our free community to join, into your profile information, and then of course RSVP for the workshop. And here's the thing, you've probably heard some people say that you should go all in on liquidity pools, put all of your capital to work, and maybe that's your initial thought, right? You have 100 grand of crypto, put all of that crypto in liquidity pools so that way you earn immense returns. And then you've also heard others say, hey, the liquidity pool strategy doesn't work, or it's too much work, or you'll never beat divergence loss or impermanent loss, meaning that you'll always end up with less money than if you just held in the market. They told you to just hodl and you don't know what to do. Well, we include both in our portfolio. We have liquidity pools, we have hodls, we have stability strategies. We also have lending and borrowing and other DeFi strategies. Point is, you don't have to marry one. You can have a bunch of different types of strategies. Now, it's important not to overcomplicate it, but you should have different types of strategies in your portfolio. One thing I've noticed about DeFi investors, typically before we start working with them at Builder Wealth, is they have analysis paralysis. They try to plan everything out, right? And planning is important. I'll go into the level of planning that we personally use and how you can do this in your own portfolio, right? But at the same time, they try to plan things to a T. I have investors that are focusing on taxes and how to manage things before they've even invested $1 into DeFi. And I'm like, man, go invest a couple grand. You might not even make any money, right? Then worry about taxes. Okay, don't worry about taxes beforehand. Yes, have some general knowledge of it, of course. It's not what I'm saying. But point is, You can't have analysis paralysis when investing into this. Otherwise, you'll be up to your eyeballs in things to think about, and you will never end up taking action. And taking action is by far the most important thing that you can do. And that's why it's important to have an accountability partner, whether it's a spouse, whether it's a friend, whether it's a colleague, whether it's a business partner, or whether it's a coach. You basically need somebody that's going to slap you in the face when you're starting to go off course and think about all these different things, right? You need somebody to hold you accountable and say, hey, like maybe we should take a step back and actually just focus on doing as opposed to focusing on what if this, what if that, and all these different scenarios. But let's just say we were to deploy 100 grand into a portfolio. What I would personally structure this as, I would probably have about 40% in liquidity pools because I am relatively aggressive. I would have about 20% in delta neutral strategies, at least at the moment. And then I would have about 15% in HODLs and about 25% in lending. Now, if I can lend out my HODLs, I will always choose that. The reason why is because, well, I'm going to earn a little bit of yield, I can borrow against them, and I can leverage up. Whereas with HODLs, those are just sitting there, and those are typically going to be my altcoins. So my Ethereums, my BTCs, my Solana tokens, my Render tokens, all that stuff, Link even, is going to be in the lending section. Whereas when we get into Aether, Desync, Tau, that stuff is going to start to be in the HODL section, simply because there aren't lending markets where I can lend that out. And that's going to make our portfolio look something like this: 40%, 25%, 20%, and then 15%, right? And then we could dive into the position types and start to go into allocations there. I'm not going to go into that in today's video, though. So again, you've probably tried out liquidity pools. You've probably tried out HODLs. You've probably tried out lending, delta neutral strategies even, maybe if you're a more advanced investor. But the thing is, you haven't put them together. You haven't created that spider web where they all rely on each other and connect to each other. You don't have synergy in your portfolio, but rather you just have these one-off little strategies that don't compensate for other aspects of your portfolio. When one strategy in my portfolio is doing bad, typically I have other strategies to fall back on that are producing consistent DeFi income. And that's why you probably don't have consistent income in your portfolio, but rather your income might be, say, $3,000 or $4,000 one month, but then $5,000 or $6,000 next month. And then all of a sudden it's $2,000 because you're in out of range positions. You have a bunch of divergence loss. Your portfolio is declined. I want to start to break things down. Let's just say that we have delta neutral strategies. And over here, we do go with the allocation of having about 20% of the overall portfolio in here. Well, if we have $20,000 in these delta neutral strategies, and ultimately we are producing about, let's just say 75% per year, which is actually very, very reasonable for the delta neutral strategies right now. That's $15K a year, or that's $1,250 per month, basically. So that right there is going to remain consistent and stable. Why? Because we are in delta neutral strategies. We are rebalancing our hedges with our liquidity pools that we have in there. We're making sure that we have consistent income off of stablecoins, stuff like that, right? We're earning about $1,250 per month, and that is consistent. That's great. Right? We can always fall back on that. We can use that to buy up more HODLs, or we can use that to accumulate more in delta neutral strategies, or hey, even some months we can pay our bills with this, or pay medical expenses, or do whatever we need with that, put that in our bank account. I'm all for keeping it in the ecosystem, though, if you want to build true long-term wealth. We also might have our LPs, which are liquidity pools, where we allocate, say, 40% of our overall capital in here. And this could be 40K, which is earning us, let's just say, about 100% APR, which is also relatively reasonable right now, depending on your risk tolerance. So obviously that's going to be about $40,000 a year, which is about $3,333 per month, basically. So ultimately, this is going to fluctuate. Why? Because when the market's down, this 40K will not be 40K. This 40K might be 30K, or it might be 25K, or hey, it could be 35K. Also, it could be higher than that, right? This 40K could easily go up to 50K, 60K, so on and so forth, and we be producing more income. So this right here is focused on accumulating more assets. Typically this, I'm compounding back into liquidity pools, or I'm compounding into HODLs. Now, if we're in a month where the market's doing very, very well and I want to take some profits, I can use this aspect, this 3333 per month, to build delta neutral strategies. Remember, that's because I'm wanting to take profit. I'm not going and selling my initial assets. I'm using the yield as a vehicle to take profit. I'm taking that 3333 and I'm putting it in delta neutral strategies. So I'm taking profit into something that's going to consistently produce me more income, but also not have the downside exposure. And we might have lending that we do as well. And ultimately, whenever the market's down, perhaps we're like, okay, Ethereum's over here at $1,500. This is super low price for Ethereum. Well, we're taking yield and we're putting it into lending for Ethereum. We're buying up a bunch of Ethereum, and ultimately we are leveraging up. So let's just say we had 25% of our portfolio over here on lending, which would be about 25K. Now, we're not going to really look at the yield here because it's going to be less than 5% most of the time. So yield doesn't matter as much, but point is 25K, reasonably, we can go and borrow 10K against this. And that's a relatively safe loan to value ratio. Again, you have to be careful, still a relatively safe loan to value ratio, which means if we get an additional $10,000, well, now we can go and leverage up and we can buy up more Ethereums. We can buy up more Bitcoins, put that as collateral again. Or let's just say Ethereum's at a low price, like I was mentioning earlier. We could take yield from LPs, yield from delta neutral strategies, and we can buy up Ethereum. And we can use those as a vehicle to buy more Ethereum. And as soon as we buy it, we can leverage it, right? Once again, in a very, very safe manner. And then after we leverage, we now have a 10K borrow right here that we have to pay back. How are we going to pay that back? We can use the yield from our liquidity pools. We can use the yield from our delta neutral strategies, or we can leave it there and eventually just pay it back on our own whenever Ethereum appreciates from the profits, basically. And then we also have our hodls, which are about 15%. So once again, 15 grand, not producing anything, but ultimately we can use the yield from the liquidity pools, from the delta neutral strategies, and we can buy up hodls. We can also go over here lending and use this 10K instead of, buying up more Ethereum and leveraging up on that specific asset, leverage up on a different asset and buy more hodls. And by having a synergetic portfolio, a spider web that connects and intertwines to each other, you can avoid the frustration of continuously working harder and harder and harder, managing your liquidity pools more, rebalancing, learning about delta neutral strategies, but ultimately still making the same amount of money, or of course losing money every single month because the market's going down. Right? So you're putting in the hard work, but remember, you have to work smarter, not harder. There's people out there that are working harder than us, making significantly less money than us. And we're over here pushing buttons on a computer, making money using our already existing money, basically. So we're already somewhat working smarter. You just have to go back to your roots and say, hey, I don't need to work 1, 2, 3 hours a day on my DeFi portfolio. I just need to put in a solid 3 to 5 hours per week on my portfolio, have synergy within my portfolio, and consistently produce DeFi cash flow. But that only comes when you have an updated and complete strategy, not an outdated and incomplete strategy like most DeFi investors, maybe even including yourself, have from 2023 or 2024 when they got into DeFi. So again, today I've shown you the framework that we're using. I've shown you the process that we take and how you can intertwine your portfolio to make it grow consistently and produce cash flow consistently. The ball is now in your court to decide if you want to implement that into your portfolio. And you really do have two options. You can go at this alone, or you could go at this with a coach and an accountability partner. Remember, that accountability partner could be your spouse, it could be your business partner, it could be your friend, your colleague, or it could be a coach like myself, as was my team. We're happy to help you implement this, even if you are a husband and wife, a boyfriend and girlfriend, right? We can help you implement this strategy into your portfolio. And we've done this with over 200 plus people. So if you guys do want support doing that, there's going to be a link right below this video. Feel free to check out our website. From there, there'll be a quick little form that you could fill out. Just make sure that you're a good fit for us, because we do only work with portfolios above $25,000 that are struggling. So that way there's a problem that we can solve. And then from there, you could speak with a member of my team. We'll make sure that we're a good fit for you, and we'll go from there. I'll see you guys in the next video, and peace out.